The biggest risk to the United States economy was never the AI bubble, never China, and never the political chaos emanating from Washington. It is something far more boring, something most people have never encountered unless they have gone deep down the financial rabbit hole. And that is precisely why nobody is paying attention to it. If you have been wondering why mortgage rates refuse to fall, why stock markets randomly freak out every few months, and why the Federal Reserve can talk endlessly about cutting rates while financial conditions still feel suffocatingly tight, the answer does not begin in Washington. It begins in Tokyo, and more specifically, it begins with the most boring asset on earth, Japanese government bonds. Because the country best known for its culture and cuisine has also been the duct tape quietly holding the global financial system together for the past 30 years. And that duct tape is beginning to peel. To understand why this matters so profoundly, you have to rewind to the early 1990s, when Japan's massive asset bubble burst with devastating force. Real estate collapsed, equities collapsed, and Japan entered what became known as the Lost Decades, a 30-year stretch of economic stagnation with no meaningful growth, no inflation and no wage expansion whatsoever. It was as if the entire economy hit pause and nobody could find the remote. The Bank of Japan responded the way central banks always do when they exhaust their conventional options. They cut interest rates to zero. Then they cut them below zero. And when that still was not enough, they introduced something called yield curve control, which sounds like a Marvel villain, but actually just means the central bank was artificially capping long-term bond yields by force, regardless of what the free market wanted. The Japanese government had essentially superglued interest rates to the floor and walked away. This created an enormous and inescapable problem for Japanese investors. Imagine running a billion-dollar investment portfolio and your domestic government bonds are paying you nothing, literally zero. You are left with only two choices: accept zero return on your capital and watch inflation slowly erode your wealth, or go shopping overseas where returns actually exist. Japan chose to go shopping, and they did so on a scale the world had never witnessed before. Over the following decades, Japan became the single largest foreign holder of U.S. treasuries, one of the biggest buyers of American mortgage-backed securities, and the world's largest net creditor nation. That last title is simply the formal way of saying Japan became the world's ATM, consistently pumping capital into global markets year after year. The mechanism driving all of this was what markets came to call the yen carry trade. The structure was elegantly simple. Investors would borrow money in Japan at near zero interest rates, convert those yen into US dollars, and then invest in American treasuries yielding 4% or more, pocketing the difference after accounting for hedging costs and fees. When your borrowing cost is essentially nothing, you do not stop at government bonds. You buy technology stocks. You buy real estate. You pour capital into emerging markets across Asia, Latin America, and Europe. The rule became straightforward. If it has a pulse and yields more than 0%, you buy it. At its peak, some of the world's largest banks estimated the yen carry trade represented trillions of dollars in global capital flows. For years, the world's financial markets were not running on Wall Street confidence or Federal Reserve policy alone. They were running on Japanese liquidity. But the entire trade rested on one single critical assumption that held everything together. The Japanese interest rates would stay near zero, essentially forever. In 2024, that assumption shattered completely. The Bank of Japan ended its yield curve control policy and raised interest rates for the first time in 17 years. Then, before markets could fully absorb the shock, they raised rates again. The reaction was immediate, severe, and globally felt. The S&P 500 dropped 6% in short order. Japan's Nikkei 225 plummeted over 12% in a single trading day, marking its worst single-day collapse since 1987. Markets were sending a clear and unmistakable message: they were officially spooked. Because when Japanese yields rise, two painful things happen simultaneously. Borrowing in yen becomes significantly more expensive, and hedging the currency risk on those overseas investments becomes more expensive too. The free money trade stops being free almost overnight. The arbitrage that fueled trillions in global investment simply evaporates. And when the math flips, capital flows flip with it, decisively and at speed. This reversal is what economists call repatriation, and it is one of the most significant and deeply underappreciated threats in global markets today. Investors are beginning to confront an uncomfortable truth. The cheapest and most reliable source of global liquidity for the past 3 decades is no longer cheap. Japan was not merely some passive, incidental buyer of American debt. It was one of the most consistent, price-insensitive, long-term buyers of U.S. treasuries in the entire world. And here is the crucial point that almost everyone watching markets is missing. The Federal Reserve controls short-term interest rates, but the 10-year, 20-year, and 30-year Treasury yields are determined primarily by supply and demand in the open market. As legendary investor Ray Dalio has long argued, the bond market is the backbone of all markets. It establishes the risk-free interest rate that ultimately determines what every asset class in the world is worth. When you combine a weakening appetite from Japan with the reality that the United States is running trillion-dollar annual deficits, forcing the Treasury to issue staggering volumes of new debt every single year just to keep the economy functioning, even a modest reduction in demand from one of history's most reliable buyers carries enormous and cascading consequences for every corner of global finance. If long-term yields stay elevated because foreign demand has weakened, stocks trade at lower valuations because future earnings must be discounted more aggressively. Mortgage rates remain stubbornly high because they are anchored to long-term Treasury yields, not to the overnight rate the Fed directly controls. Corporate borrowing costs stay elevated, risk appetite across industries falls, deal flow slows, capital tightens, and growth decelerates throughout the entire real economy. The simplistic narrative that one Fed rate cut fixes everything, that liquidity is automatic, that someone will always show up to buy American debt, is not just incomplete, it is dangerously misleading. Liquidity is the oxygen of global markets, and for 30 years, Japan supplied an enormous portion of that oxygen through the cheapest borrowing the financial world had ever seen. That trade is now unwinding quietly. The cost of money is shifting at its very foundation, and almost nobody in mainstream financial media is discussing it, because it does not trend. It does not generate clicks, and it demands patience and nuance to fully understand. But the real threats in markets are never the loud, visible ones. Those are usually already priced in long before they arrive. The real threats are always the ones hiding in plain sight.